We're finally at the last video of today's lecture. In this section, we're going to talk about how transfer pricing can be used to move taxes across different jurisdictions. So the issue of centralization or decentralization and the importance of coordination can also be seen in the connection between transfer pricing and taxes. So as we all know, tax rates might be different across different cities, states, and countries. Given these differences in tax rates, companies have incentives to report as much income in the jurisdiction with the lower tax rate, because that means they'll be paying less taxes, and report smaller income in jurisdictions with the higher tax rate. This requires a lot of coordination because it means that the unit in the higher tax rate jurisdiction has to be open to reporting as little income as possible, or sometimes even a loss. So let's look at a situation where companies can benefit from shifting their profits to lower tax jurisdictions using a short example. So MTK manufactures sunglasses in Mexico and transfers them to an Australian subsidiary that sells them for 85 Australian dollars. So that's the selling price. The variable cost to make each pair of sunglasses is 20 pesos. That's the variable cost per unit. And for simplicity, we're going to assume that 1 peso equals 1 Australian dollar. The tax rate is different. Mexico has a tax rate of 30%, and the tax rate in Australia is 40%. Finally, suppose that there is a tax treaty in place that allows MTK to set the transfer price somewhere between 40 and 60 pesos. So they can't set the transfer price lower than 40 or higher than 60 pesos. So assume that MTK decided to go with the lower bound and set the transfer price at 40 pesos. How much taxes would they be paying? Starting with Mexico. So the Mexico office, their revenue per unit would be equal to the transfer price per unit, which is 40 pesos. And their variable cost per unit is the variable cost of producing the sunglasses, which we learned is 20 pesos. That's 20. So the taxable income in the Mexican office for one pair of sunglasses is $20. And with a tax rate of 30%, MTK would be paying 6 pesos as tax to the Mexican government. Now let's go over to the Australian office. So the Australian office will sell each pair of sunglasses for 85 Australian dollars. And their variable costs will be equal to the transfer price of 40 Australian dollars. Their taxable income, therefore, is 85 minus 40, that's 45. And with a tax rate of 40%, 45 times 40%, MTK will be paying $18 as tax money to the Australian government. So in this case, the total taxes paid by MTK is $6 to the Mexican government, $18 to the Australian government. So that's $24 for each pair of sunglasses that they sell. Now let's look at a situation where MTK sets the transfer price at the upper bound, which was 60 pesos. So now, for each pair of sunglasses, the Mexican office incurs a revenue of 60 pesos, which is equal to the transfer price. And their variable cost is still equal to 20 pesos. So that their taxable income is 60 minus 20, which is 40 pesos. With a tax rate of 30%, MTK will pay the Mexican government 12 pesos as taxpayer money. For the Australian office, we're still selling the pair of sunglasses at $85 a unit. And the variable cost is, again, the transfer price of $60. So that the taxable income is 85 minus 60, which is $25. And with a tax rate of 40%, 25 times 40% equals $10. So MTK will be paying $10 as taxes to the Australian government, so that the total taxes paid by MTK would be 12 plus 10, $22 for each pair of sunglasses. So what just happened? By setting a higher transfer price to we effectively shifted more of the profit to the lower tax jurisdiction of Mexico. And by that, MTK is now able to save $2 of tax money for each pair of sunglasses that they sell, which is pretty neat. So in the context of this problem, why do you think there is a tax treaty between Mexico and Australia? Well, the government of each country is not stupid. They know that there is some opportunities for companies to shift profits to a lower tax jurisdiction. So the countries came together to set a tax treaty to limit profit shifting by companies. So what they're doing is trying to decrease the opportunity to shift income to lower tax jurisdictions. So that was the objective of the tax treaty between Mexico and Australia. Now let's look at a video together that talks about some profit shifting practices of companies and how governments are dealing with this issue.